Well, just to comment on October, it's long considered a terrible month because it's been the month in which two great crashes have occurred. But if you look at it over time, actually, it's been about flat. So October's reputation is not entirely deserved. But yeah, unfortunately, we have a president in the United States right now who, for some extraordinary reason, thinks global trade is a bad thing, or at least US deficits. I think one of the only things everybody can agree on is that global trade is a force for good and for growth and for improving the living standards of everybody, including US consumers, and a deficit is not a bad thing in trade. But unfortunately, even for this president, who changes his mind sometimes in the same day, on this issue he has been consistent for 40 years. He was opposing trade deficits in the US back in the 70s, and he still is today. So this is something markets have to recognize and accept, and actually it's something we took into account positioning our portfolios back in 2017. As to now, I'm not surprised at all to see him go after Europe. Actually, consistent with his thinking, the Europeans are even more of a danger than China. Collectively, the EU has a bigger trade surplus with the US than China does.
So I want to know how you are investing and allocating around this, because yes, that slowing growth narrative is there, but at the same time, there are opportunities. What do you think this means for the companies within your portfolio right now, and how do you position amid these uncertainties in US foreign policy, in global markets and around the world?
Absolutely there are. And the first thing is you must study your portfolio very carefully and see if you can be insulated from these factors. And you can. China, plenty of things going on domestically. The government there, it's not turning on the liquidity taps, but it's gently stimulating the economy in certain areas. We've been very big in cement. Obviously benefits from infrastructure development, which is seeing a little bit of an uptick. Domestic consumption, you can see that the consumer is benefiting from tax bracket increases, tax cuts in certain areas, and other things to support local consumption. And in fact, Goldman Sachs recently produced a report which shows that when you combine these tax cuts with the impact of the exchange rate, it kind of neutralizes the tariffs so far through this year.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.